Hey everybody, welcome to another Foundation webinar. My name is Brian Cancian. I am the Business Development Manager here with Foundation, and we're just waiting on some more attendees to trickle in here. It's just the top of the hour, so we're just going to sit tight for a few minutes, let more people join, and we'll be back with you in just a moment. All right, everybody. Welcome. It is just a few minutes after the hour. We still have some people trickling in, but we are going to get started. Again, my name is Brian Cancian. I'm the Business Development Manager here with Foundation Software. Um, Today, we are joined by Jesse Weisberg of Build, and we're going to be talking about smart capital strategies for subcontractors. Again, two of us are here today as your hosts for this event. We're going to be talking about, again, just basically cash flow for your projects, the unpredictable payment cycles that you might experience, cash flow challenges, kind of filling in that funding gap, accounting for the cost of capital, and including that in your bids, and just overall developing a strong capital strategy as a way to combat the industry's biggest challenges today. Just some basic housekeeping. We will open the session up to Q&A as we get to the end of the event. Before we do that, we will be launching a poll, so we'd appreciate your participation in that. The 2025 National Subcontractor Market Report that has been put together by Build will be included in a follow-up email along with a link to the recording of the webinar. And going to do a quick plug here for those of you who might not know. We have our semi-annual, or not semi-annual, annual, every other 18 months or so, Converge 2025 coming up. It will be running October 6th through the 9th in the fabulous Las Vegas at the Mandalay Bay Resort and Convention Center. There will be something for everybody. All of our product lines, staff will be present and accessible for you. Tons of courses for everyone from the basic data entry folks that you may have using Foundation all the way up to the C-level owners, et cetera, within the organization. There's a lot of activities, meals, social networking events, and of course a vendor pavilion where you can talk to other companies that we work with in the industry that kind of supplement the things that we do here at Foundation and with all of our products. So with that, I want to introduce our host or our guest speaker here today, Jesse Weisberg. Take it away.
Yeah, thank you, Brian. Just a quick intro on myself and Build. Again, Jesse Weisberg, co-founder and chief commercial officer of Build. Build, if you're not familiar with us, we provide financial solutions specifically for commercial subcontractors. We help them with their capital strategies, how to navigate, the cash flow challenges that are unique to commercial construction. And we've been in operations for about 6 years now, and we fund, subcontractors throughout the U.S. and in all 50 states. My background is in finance, real estate, energy, banking, and construction. So a little bit of everything, and just really excited to be here with Brian and you all today, and kind of talk through the landscape and what we're seeing and hearing out there in the market.
Great, that's fantastic. So let's get started. Obviously, you guys put together the 2025 National Subcontractor Market Report. Again, that will come out in the chat along with all of the links to our Converge information and emails for questions. But just getting into this report, it was really interesting read for sure. A lot of things kind of stood out, but one of the well, let's just talk with the big picture, right? Let's start with this. This is your 5th year doing this report, right? And why did you create it, and what can our guests and just subcontractors in general expect to get out of the report?
Yeah. Great way to kick it off. Our mission here at Build is to be the champion of the subcontractor. And one of the ways that we champion the subcontractor is by arming subs with access to information. Obviously, our specialty is cash flow, finance, capital deployment, and there's a lot to unpack there. There's some things that are specific to construction that are pretty difficult to navigate, like long payment cycles, just access to capital in general. So we really want to develop this report to make sure we understand the changing landscape, and then also to arm subcontractors with what are the tools and tricks that their peers are doing to navigate, the choppy waters, so to speak. So it's not all about just pointing out, the challenges with the industry, but then also what can subcontractors do proactively to navigate.
Great. That's amazing. So one of the stats that jumped out at me was that it takes a subcontractor an average of 56 days to get paid after they submit an approved pay application, which, I mean, considering the fact that we're fronting labor costs, we're buying materials up front, how do you do it? How do you manage your cash flow?
Yeah. And I would start by pointing this out. Obviously, everyone on the line here is in construction. This isn't typical. When you look at other industries, this cash flow gap that faces us in construction is pretty atypical. And to further complicate things, most subcontractors are working with up to 5, 10 or more general contractors. They all have different payment terms. So managing that 56 days to get paid, it's not like it's 56 days with every GC. It really changes from GC to GC, which further complicates things. On average, most subcontractors have 30 to 45 day payment terms with their suppliers. So there's a little bit of breathing room there. But that naturally, we just said there's 56 days to get paid, and you have to pay your supplier in 30 to 45 days. Well, there's a gap. And what that ends up leading to is the subcontractor having to float the delta between when they're paying labor, materials, and then when they actually get paid. It puts a lot of stress on the business. It forces them to prioritize, which suppliers to pay. Obviously, they have to pay their labor. But then more strategic initiatives in terms of growth, do you take that risk? Do you take that extra project? And it's continue to say this, it just makes it difficult to navigate for the subcontractor when they're faced with these options every month. Do I do this or that? And it's challenging. It's very challenging.
Yeah, no kidding. And there's a disconnect between the subs and the GCs, right? Like the GCs think that they're paying promptly, they're paying quickly, right? And the subs are like, we're struggling here. Like,
Yeah.
how do you address that?
Yeah. GCs, there are payment terms that the owner dictates with the GC, and the GC passes those payment terms down to the subcontractor. It just flows right through. But from the GC's perspective, on average, they think it takes about 30 days for a subcontractor to get paid. But generally, their clock is starting when the owner is approving the pay app and then the GC is receiving the funds. What the GCs don't realize is, the sub submitting a pay app maybe on the 20th of the month, and then there's some processing time to receive payment after the GC is paid, which creates that difference. It's not 30 days, it's roughly 56 days. And that disconnect is hard. It's hard for the GCs to understand. It's hard to communicate to the GCs, but it's real, and it puts a subcontractor in a tough spot.
Definitely, absolutely. I mean, it's mind numbing. So let's talk about the funding gap then, right? So it's mentioned very frequently in the report. So what is it that you're referring to when you say the funding gap, and why is it such a problem for all of our subcontractors?
Yeah, this is when we poll subcontractors. This is one of the biggest challenges. Besides just finding labor, this is one of the biggest challenges in their business. The funding gap is the difference between what subcontractors owe in regards to materials and labor on a project, or on, let's just say, their cumulative projects, and what they have in working capital. So when I'm referring to working capital, that's banks, lines of credit, credit cards, supplier terms, but just these tools, in a vacuum, they're not enough. And when we polled subcontractors, roughly half, 43%, said they do not have enough working capital to cover the unexpected costs that they run into on a project. So this is the funding gap. This is what causes subcontractors to use retained earnings, which is cash. This is what forces contractors to pull funds from their retirement that they've already taken out of the business. So this is one of the biggest challenges that they face.
Yeah, that was a crazy statistic that I picked up from that report, was how many of the owners of these companies are personally financing some of this work, covering that gap by themselves. It seems very risky to me.
It is, but unfortunately, most businesses at some point in their life cycle, they enter into a situation where they have to.
Yeah,
Maybe they ran into an issue on one specific project. Maybe they misbid a project. There's a myriad of challenges that they could run into where they have to inject more capital into the business, and that's coming straight out of their wallet.
yeah, yeah. It's things you don't think about when you're not dealing with it on the day to day, for sure.
Yeah.
So we now know what this gap is. What do these subcontractors do when they don't have the capital to cover, besides the last resort of pulling it from personal savings?
Yeah, a lot of times the first thing that they're doing is just moving cash from one project to the next. They can't line up perfectly the proceeds from one project to that specific project. And then that just creates this really murky situation that creates it just is difficult for the sub to wrap their hands around their overall cash flow. That's one thing. But typically, they always have to pay their labor force. That's the first thing that they have to make sure that they take care of. So then what do they resort to? And that's typically not paying their suppliers. Instead of, they have net 30 or net 45 terms, they're paying in 60 or 75 days. Now, what subcontractors don't totally understand or appreciate is this really has a massive financial impact to their business. And I can unpack that here for a second. So if I'm a subcontractor and I'm paying my supplier in 50, 60, 70 days, the sub may not know this, but suppliers are going to bake that into their cost. So a subcontractor may think, I am getting the best cost, best unit cost. But what we found is on average, suppliers will increase the cost of materials up to 11% for subcontractors who are paying outside of term. So if you're in a really strong position and you can pay for those materials within term, you can negotiate better pricing, which results in savings when you're bidding a job. So that's huge. And then obviously, if you have this gap, the result is you can bid less projects, you can take on less projects, that impacts your revenue and future growth.
Wow. So there's good news, right? There's good news for subcontractors, and some of them are figuring it out, right?
Yeah,
Your
absolutely.
report says that the subcontractors, and I found this hard to believe, but I'm sure there's research behind it, right? Subs who include the cost of capital in their bids, meaning they're bidding higher on a project, still getting the work, but they are also showing to be 41% more profitable.
Correct. But just because they're including the cost of capital in their bid doesn't mean that their total bid amount is higher. And let's get into those details because I think it's really helpful to unpack that. But you're right. For subs that are including the cost of capital in their bid, they're more profitable. And that makes sense because there is a real cost. Obviously, when a sub goes to bid a job, they should be including all of the costs that they're going to incur. If they do not, that eats directly into the margin. Pretty self-explanatory. If you don't, then you have to absorb them. They come from somewhere, and there is a cost of working capital. Whether it's, obviously a line of credit or credit cards or whatever, there's like an actual cost that they can point to. But even if it's your own cash, there's a cost to the cash. Because if you're using that cash to fund projects, that's otherwise cash that you could use to invest in efficiencies in your business. You can hire additional crews, more estimators. You can invest that cash. I'm sorry. For software, exactly. And this is something that we harp on with all of our customers because there are actual dollar savings, and it will make you more productive, allow you to take on more work, which leads to more revenue and more profit. So when you include the cost of capital into your bids, what that can allow you to do is retain your cash, and that cash then you can use to pay your suppliers on time. We just talked about how subs who don't pay their suppliers on time are going to pay more for materials. And then you can also invest in software and technology and so forth to drive more efficiencies into your business, which can lower your costs in other areas outside of the financing to reduce your all-in bid. So not only are subs more profitable when they're including the cost of capital, they're also winning more bids. And that this year was eye-opening, and no surprise there, but there is a trend where more and more subcontractors are including the cost of financing in their bids, and they're obviously winning more as a result.
Right. So the report mentions strong capital strategy. You can see it here on this slide that's on the screen, right?
Yeah.
What does that actually look like for our attendees?
Yeah. So most subcontractors, when they think about working capital and how to deploy working capital, and this is natural, they immediately think, I'm going to go use the source of capital that's the cheapest, cash, line of credit. Now, depending on your growth strategies and so forth, that could make sense. But for the majority of subcontractors out there, really how you protect your business and fortify it, you really want to be, one, diversifying your working capital. But additionally, starting with your less flexible sources of working capital and then kind of working from there. So what is a unflexible source of capital? Supplier terms. You can only use that for materials. So obviously starting with something like supplier terms, and tools like build, material financing that can only be used for material. But something like cash, you can use cash for anything. And when you use cash first and you end up in a situation where you have a funding gap, well, now all of a sudden, like, how are you going to pay your labor? So when we talk about capital planning and capital strategy, it's really important to understand what are all the different tools at your disposal, what is the best use for each one of those based on where you're at financially, and really think proactively rather than reactively to how you deploy those different sources of capital.
Very interesting. It sounds easy. So
Yeah, I wish it was that simple. I wish it
just
was.
wave the magic wand, right, Jesse? Just wave the
Exactly.
magic wand. So no, seriously though, for everyone that's here and listening and will be watching the recording down the road, and they're thinking, where do I start? What would be your advice?
Yeah, I mean, the very first thing to do is to figure out where do you stand today from a working capital perspective. What are the different options you have available in the business today? Where do you stand in terms of available working capital and what is needed over the next, let's just say, 90 days? And that kind of sounds obvious and like an easy exercise, but the reality is it isn't. You have retained earnings that are coming in. You don't know exactly when you're going to spec them. You have a project that's supposed to kick off in 30 days. Maybe it's pushed out a little bit longer. You're waiting on a pay application that still hasn't been paid from, at this point, maybe April. But and that is super uncomfortable. So number one thing is figure out where you stand today, and then just what do you need for the future. And if you don't have a financial resource in house like a CFO, find one. There are fractional CFOs out there. You can talk to your accountant. I'm sure companies like yourself have connections. I mean, that is the number one thing to do, is arming yourself with the knowledge so then you can put the plan in place. Because ultimately, this is all about being proactive rather than reactive, and evolving to a place where you can be proactive.
That's great. That's great. This has been really interesting. It's like I said, I just reread this report right before jumping on this call, and some of the numbers and the statistics are kind of just they're mind numbing. The things you just don't even think about, right? I worked with these companies for many years while I was in the consulting role here at the company, and you know, just don't have exposure to where the cash is coming from. We talk about, WIP reports and everything else. And, obviously there's your AR aging. You can see all these things that are sitting out there, 60 plus days. Um, but it's just, until you're in the thick of it, you just don't have to deal with it. So it was very educational for me. I'm hoping that it is educational for everyone here online with us today. Are there any final thoughts that you'd like to share on what you hope our attendees can take out of this report?
Yeah, I mean, I think the big thing is the challenges that face construction. They're not changing, and as it relates to cash flow and managing cash flow, they're not going to change anytime soon. Technology will help with this over time. It has, but it's not like this is something that is going to be overhauled in the next 12 to 18 months. But there are ways for you to take action today, like some of the things we talked about, like including the cost of capital in your bid. One of the most important things you can do is go and get access to capital when you don't need it. I mean, that is unfortunately when banks are most likely to extend capital, and really putting yourself in a position so you can be proactive with your capital planning rather than reactive. I mean, that's the end goal here. And that's just what I really hope people leave here with that goal.
It's kind of an overall good lesson in life, right? Be proactive instead of reactive.
Yeah.
uh, it, Things just don't generally go well when you're reactive. That is for certain. You're forced to do things that you might otherwise not want to do, and that's never a good feeling. Not at all, right? So that's really great. That's really great. So for everyone that's here right now, we are going to open this up to Q&A in a second. We're going to have a poll launched here right before we jump into Q&A. There is a little question icon up at the top of your screen. That is where you can access the questions pane. Feel free to type a question into that and submit it. We'll be monitoring that as they come in, and we'll have Jesse address those questions as they come through. So we'll give everyone a chance to vote here. Got 13% voted. Come on, everyone. Just one click or two. And while we're waiting on that, we do have a live question right now. Does including the cost of capital in bids require a change to the bidding process?
The actual bidding process, well, I would love some clarification on the question. Bidding process is kind of a loaded term. I assume this is internally and not with the GC. I mean, typically GCs don't like to see the cost of capital broken out as its own line item. Typically what we see subcontractors do is calculate whatever their cost of capital is. Let's say on a project it's 1%. They take 1% and then they spread that across all of the different line items on the bid.
Yeah, it's really looking at the estimating process, I would imagine. And like on our end, I would consider that part of the overhead calculation, essentially.
Yeah.
Right? Raw cost, we've got profit, or we got overhead, and then we have profit. And that, I think that's where I would generally put that in. Here's another good one. So how would we calculate the cost of capital in our bids? I think you kind of already mentioned if it's 1%, it's 1%. Right?
Yeah, it really just depends on what are the different capital sources at a company's disposal, right? So if it's line of credit, material financing, cash, I mean, there is a cost to the cash. And that is something that I would recommend you work with your CFO or VP of finance or a financial resource to figure out, because it is different for every business, but there's an opportunity cost to your cash. And you come in, you do need to develop a number, but then also there's the cost of capital for the bid, but then there's how long on average does it take to get paid by the GC that you're bidding. And you need to look at both the time that you have to float and then the cost of the different capital options that you'll have to leverage on a project, and you need to combine those two.
Right. So, and I think if you really look into that, right, and you start looking at who are you working for, and you might come down to a point where you don't want to bid work for certain GCs anymore. I mean,
right, or you can be more aggressive with other GCs, right?
Correct. Right. Or if you are going to go with those GCs that you might otherwise not want to work with because of their paying habits, you can, buffer that a bit a little bit more to cover more cost.
Exactly.
I guess if you don't really want the work, write a little bit more into it, and if you get it, bonus, right?
Yep.
So another really good question here. I like this. I can get early pay discounts of 1 to 2% from my vendors for early payment. Does it make sense to use debt to take advantage of these discounts?
So early pay discounts, I assume this is referring to their material distributors.
Most likely, I would imagine. Yeah, let's
Yeah.
assume that.
What I would say here is first, 1 to 2% is without negotiating. Typically, if you pay a supplier up front or a vendor up front, you can negotiate more than 2%. I mean, that's just kind of their off the shelf rate, 2% net 10. So I would urge you to negotiate higher. We see anywhere from up to 7%, depending on the type of materials. And does it make sense to leverage debt? It absolutely can, depending on the cost of the debt. So back to factoring in the cost. I mean, it's pretty simple to uncover, to do those calculations, but that's the math you got to work through.
Yeah, I mean, for sure. If you're saving 5 to 7% on those materials and you're going to eat 1 to 2% on the debt, it's good math.
Right. Exactly.
How about this one? And I know that nothing was specifically mentioned during the course of our conversation, but what about retention financing, right? Sometimes 5 to 10% of their cash is out for months. I mean, depending on the duration of the project, it could be years, right? That's huge. What options do we have?
Well, what I can say is there aren't any options in the market right now. Build may or may not be working on something.
No promises.
But there really aren't. We always joke, retainage, let's say it's typically 10%.
Mm-hmm.
That is the subcontractor's profit. So, as you grow, your retainage grows, so your profit is pretty much just rolling, and it's tough. I mean, this is one of the biggest challenges that subcontractors face, especially when they're growing. So this is something that we talk a lot about.
Yeah. Stay tuned, right?
Exactly.
So how about this one? Do you only lend against GC bonded projects? And if not, what's your typical spread between bonded and non-bonded projects? And also the same question really with private versus public work.
Build specifically, we have two different products. We didn't really talk about them. We have material financing, and then we have a pay app advance product. And we do provide those financing options both on government projects, and private, bonded, unbonded. We kind of play in just the general commercial space. Now, what I will say is we do evaluate those projects based on certain criteria, and we look at the strength of the project when we're determining how much money to extend. Just like a subcontractor should be looking at the strength of the GC when they're going, and the payment terms when they're going to bid a project. So that's a topic for another day. But if there's interest there, I would recommend they reach out, and that's something my team could talk through.
Yeah, I'm thinking we're going to get a similar answer here in terms of reaching out and talking more in detail. But this question is asking, how can we include the cost of capital in our bid when you're in a market that is only buying like low, if I can quote in all caps, low, not necessarily not bid, right? So if we're taking low bid, how do we avoid making that cost of capital push us over and so we can get awarded, low bid?
Yeah, I mean, this is another one that would take some time to unpack. I think we would want to better understand what all is going into that bid, and what are the market dynamics based on that trade and the specific type of projects that the subcontractor is bidding on, and what are we seeing with other subcontractors, maybe in other markets? And this is where you're able to kind of crowdsource some of the different ideas and tools available. But unfortunately, I mean, this is just something it's hard to unpack without more information.
Yeah, and this one is probably right in that same bucket there because Michael's saying, up until recently, you could see being able to charge for the cost of capital, but the bid markets have tightened over the last 6 months, and not really seeing how they could stack anything else on top of the bid. And I think, again, back to the point was looking at the cash management and, looking at suppliers. I mean, it's because materials are a significant portion of the project, right? And if you
Yeah.
can negotiate early pay terms and acquire that capital to finance that at a lower cost than the discounts, that could be one of the ways to bury those costs or that cost of capital into the project.
Well, yes, there's the discounts, and that's one piece of it. But the other is best price. Most subcontractors think they're getting best price, but when are they actually paying their supplier? And most subcontractors are paying outside of term. So if you're able to pay your supplier within term, how does that reduce your cost of materials? And then how does that impact your bid? So this is where that proactive nature, and it can be difficult to kind of go through that transition. But once you get through that transition and you're actually able to reduce the cost of your materials, I'm not talking about discounting up front. I'm talking about paying in term. That can have a real meaningful impact on your bid.
Right. Yep. So a follow-up question there is so what is Build? Are you a bank or a factoring company or what?
Yeah, a lot we get thrown. A lot of people immediately go to factoring, which I understand why. We are not a bank. We are a working capital provider. So we have different working capital solutions built specifically for construction. So for example, we have a material financing product that allows the subcontractor to pay their supplier up front for the materials. We in fact pay their supplier up front, and then we give the sub 120 days to up to 120 days to pay us back. So that's one, and that really helps when you're mobilizing. And then another is our Pay App Advance product. And instead of waiting the 56 days to get paid, you can get paid within a matter of days of an approved pay app. So you're injecting that cash immediately into the business. And those are our two products. But really, what we like to do with our customers is sit down and really help them, put together a capital plan that involves Build, involves a line of credit, involves their cash, supplier terms, and figure out what is the best plan based on the goals of the business, and work with them to help them achieve those.
Right. We've got a couple comments here. One saying that some states allow you to bond retention on public works jobs, specifically Washington and Oregon. I know a lot of our clients may be in those areas, but I know we're spread around the country. So we don't know what kind of opportunities exist throughout the country. And the other option, obviously overriding terms and conditions into your contracts, specifying they got 30 days to pay regardless. But I know anymore GCs, I mean, pay when paid is largely the norm. And negotiating that, good luck. I mean, if you can do it, great, right? I mean, that's better for everyone, but just doesn't seem to be the way that GCs are operating these days.
Yeah,
for sure.
Yeah, that's
Yep.
tough. I mean, we talked about it earlier. They're mostly a pass through. Whatever terms they receive from the owner, they're going to pass on because they don't want to bear the brunt of any of the gap in the cash flow.
Yeah.
Cycle.
Yeah, no kidding. I mean, they've got the control there, right? And I know I've talked to some that some general contractors just like, we don't care. We're gonna get paid and we're gonna hold on for even if it's just 7 days. And contractually, if it's pay when paid, that's not ideal, not on the up and up, but it happens. It happens all the time. So, dangling those carrots, yeah, checks in the mail, right? So, and anyway, that does get into, from the payment terms side of things, a lot of you might have heard announcements, we've been doing a lot of things in the fintech space, right? So we've got the ability to accept credit card payments now. And we're happy to talk to you guys. If you have questions about it, just reach out. That's fine. But we can accept credit card payments that push right into foundation. And we're working through a few different things. But one of the upcoming items is going to be automatic bill payment. So you select what you want to pay out of foundation. and send that directly to a third-party payment provider that will look at how can we get these vendors to accept virtual cards and so on and so on and so on. And that can generate rebate, which can, help soften some of these costs of financing, of everything else. So, there are creative options in our technology, and just the various options available in the market today can really help with that. We have one more question here. I'm not sure if you can answer directly or not, if it's situational, if it depends on the company and so on. But just questioning, what are your interest rates on these various funding options, and why are you different than a factor?
Yeah, I mean, what I would say is it really depends on the credit worthiness of the subcontractor. Generally speaking, well, it depends on the credit worthiness and how long they need the funds, not the rates per se, but the cost of capital. And, if you're including the cost of something like build into your bid, it's probably around 1%, 1 to 2%, however long you need the materials. So if you want to learn more about the interest rates, please reach out and we can walk through that.
Great. That's great. Well, Jesse, it is 2:41, and I'm not seeing any additional questions. Oh, there's a follow-up that came in here for that interest rate and different than a factor question. It's just an FYI that they are working on a direct pay to subcontractors on City of Chicago projects, which is interesting. So if I read that correctly, the funds that are being paid directly to the subcontractors and not necessarily straight to the GC, which is something I've not heard of.
Which probably means they are not receiving payment for something like 60 to 90 days. I would imagine if they're receiving payment directly from the city. But you're right, I'm not familiar with the structure either.
Yeah. So anyway, we don't seem to have any other questions coming in here. So I just want to thank you, Jesse, for taking the time to sit with us today and go through these, really important topics. Cash, what does the report say? Cash is king, so treat it like a queen. Right?
Yeah.
I think that I've not heard that one before, but it certainly makes really good sense. So again, I just want to thank you for joining us and just giving us some educational content for our clients. We really do appreciate that. And everybody, the links should be posted in the chat. You'll be receiving those in with your follow-up email. Then I'll have a link to the recording for the webinar. And Jesse, unless you have anything else.
No, just really, really appreciate the time. This is obviously a very important topic, and we're just very appreciative that there are more people out in organizations like Foundation Software that want to have this conversation, because it can be uncomfortable when you're talking about the finances of a business, and the fact that folks like yourself and subcontractors and even GCs, the temperature is starting to rise a little bit, and people are willing to have the conversations, and that's really the first step. So just thank you for the time, thank you for having us, and just appreciate being on.
Absolutely. And for everyone still left here, we absolutely appreciate you guys taking the time to join us as well. If it weren't for you guys, we wouldn't be doing these. So thanks again, everybody, and we'll see you next time. Thanks, Jesse.
Thanks, Brian.
See ya.